Two people walk into the same bank, speak to the same tellers, and agree to the same terms of service. Yet the moment they leave, their experiences diverge based on a single variable, the balance in their accounts. At the lower tiers of the ladder, banking is an automated process. These are environments where the system operates without the interference of human judgment. In this bracket, every interaction is governed by a rigid protocol that reacts to numbers rather than circumstances. At level 1, dipping even a few dollars below zero triggers an automatic penalty, often around $35. If you have several small transactions pending, the bank may process them individually, applying consecutive charges that multiply the debt before you can intervene. This is where financial stress becomes a series of calculations at a checkout counter, trying to guess which transaction will clear and which will result in another decline. Even at level 2, with a few $100s in the account, the costs persist. Monthly maintenance fees of $10 or $15 are common unless you maintain a minimum balance of $500 or even $1,500. This chart shows the disparity in how that money is used. While a savings account might yield a nominal 0.01%, the bank uses those same deposits to generate significantly higher returns through its own investments. At these levels, the system does not adjust to your situation. It simply applies the rules. You aren't being treated as a client, but as a risk profile managed by a script. As income stabilizes and savings grow into the 5- or 6-figure range, the bank's automated responses begin to shift. Proven consistency effectively deactivates the most punitive rules. Maintenance fees disappear, and the bank begins offering access to actual credit lines. This graph illustrates the shift in the cost of capital. As the savings balance moves higher, interest rates drop on the vertical axis. The money saved on these lower rates stays in your possession, acting as the primary engine for further growth. At this middle tier, the institution is functioning as advertised. It isn't providing special treatment, it is simply providing a standard service for a low-risk user. When assets reach the $500,000 threshold, the mechanics of the relationship move into a different category. The automated algorithm is sidelined. In its place, the bank provides dedicated wealth managers to oversee the account personally. Instead of an automated decline, it triggers a phone call. Errors are corrected immediately, and fees are often waived before you even notice them. This level provides access to custom deals and specialized investment teams that aren't advertised to the general public. Policies that seemed rigid at lower tiers suddenly become flexible. You are no longer navigating a computer system. You are managing a personal relationship with an individual who has the authority to make exceptions. Across these 8 tiers of financial reality, the architecture changes completely. The bottom tiers represent rigid, automated rules low-balance users must navigate with no room for deviation. At the top tiers, the system expands and reshapes to accommodate the client's needs. This transition isn't a move toward a fairer system, it's a move toward a favorable one. At the highest tiers, your status changes. You are no longer a customer reliant on a service. You are an asset that the bank is incentivized to keep. The institution actively works to protect this relationship, bending its own internal policies to ensure that your capital stays within its vaults. The paradox of modern finance is that at the lowest levels, you must adapt to the system to survive, but at the highest levels, the system adapts to you.